Now, let me just talk a little bit about bonds because I've gotten a lot of questions as well about you have said to get out of bonds, but then there's some bonds you want to stay in and so on and so forth. So let me just recap this slowly. It's important that we all get this. If the markets are down and the bond market appears to go down, and I believe that the bonds are going to be going down, I think bonds are going to get hurt in a next real recession, more so maybe than even stocks. But when I say bonds, I am 99% of the time, I am talking about two things: bond mutual funds and long-term individual bonds. Okay? Now, I am okay with you owning individual bonds because many of you own bonds that are municipal bonds, and they're relatively strong, good, solid bonds, and they're going to mature in a short period of time. And I say short period of time, I'm talking about 3 to 6 year range, which would be like a midterm bond. Anything beyond that, I might be a little bit concerned about. But if you own an individual bond, whether it's an individual corporate bond or a government bond, that is paying you a specific amount. So let's say this bond is paying you 3.5%, and it matures in 4 years. You're going to get that 3.5% for 4 years. When it matures, you'll get your money back. You'll get your principal back. Okay, so that's not such a bad thing. Now, in that 3 or 4 year period of time, could interest rates go up to 5 or 6%? Sure, that is possible, particularly in the environment in which we live today. So the theory is that if that happens, you're kind of stuck. Nobody's going to buy your bond, so you're kind of stuck waiting for it to come up, waiting for it to mature so that you can get the higher interest rate. So you're losing some money technically because you could be in higher interest rates. But, for a year or two, if that were to happen, it's not going to be that big of a deal. And it's not worth selling this bond now at a potential loss in order to just have that money sitting on the sidelines, hoping that interest rates are going to go up. I've been talking about interest rates going up now for 4 years. They haven't yet. So I say they're okay. So an individual corporate bond, an individual government bond that's paying a set amount that's going to mature 5, 6 years, that's okay to keep those. Even if I say sell bonds, I'm usually meaning to keep those. And that's something that you need to be aware of. So I don't have a problem with that. But the bond mutual funds are a different story. They have long-term bonds. They have mid-term bonds. They have short. If you are in a very short-term mutual fund, a Ginnie Mae fund, or a short-term, it says in the name of the bond, short-term bond fund, short-term municipal bond fund, short-term corporate bond fund, whatever it might be, if it's short-term meaning 2 to 3 years, then it's not going to get hurt as much as some of those other bond funds, and it may not be so bad to stay in there. I would caution you on all your bond funds, whether they be short-term or long-term mutual funds, don't reinvest dividends, please. If you're if you're over 55 or over 60 for sure, or you're retired, don't reinvest the dividends. Get that dividend money paying out to your money market account so that you can see that fund working for you. So you get to see, wow, you know what? This bond fund, not only is it producing 3.5% every, year, I'm actually seeing it. It's going into my money market account and it's growing my cash, and that's a good thing. So it helps you feel a little bit better about that fund, and I think that's important. So it's just like I say about if you're retired or if you're in preferred stocks or if you're in an income-producing bond, don't reinvest it. It's silly. Get the money and put it in. Oh, well, people say, well, you reinvest it, you're going to get more shares. Yeah, I'm talking about if you need the income. That's what I'm talking about.